Arvind Sanger, managing partner, Geosphere Capital, with us on the show this morning. Arvind, very good morning to you, and
Hi.
great to chat with you as always. Let's start before anything else with the pre-20th Jan setup, because that is undoubtedly the big factor that will be seen across commodity classes, across asset classes, and across all markets.
Well, I mean, I think people are getting too excited too soon, in my opinion. Yes, Trump is going to be an important, change from the current situation. And I think the most important thing that has happened in the last 48 hours is his threats having resulted in a potential Gaza ceasefire. So I think, part of the pullback in oil prices, if you can put a finger on it, what you were just talking about, is kind of an assumption that maybe some of the tensions, some of the disruptions caused by the Houthis, some of the other things that might get reversed. So yes, there is obviously, some expectation he's going to be taking some aggressive efforts to also end the Ukraine-Russia situation. So he's clearly, starting off with some credibility here. We'll see how it goes.
Okay. The other aspect, Arvind, hi, Alex joining in. Just want to know your opinion on the bond yields and how they've moved over the last couple of days. Quite wild in the way that they've swung from 4.8% or thereabouts in the 10-year to 4.6% now, 20 basis points. Does that indicate that we're moving downwards from here, or at least finding a little bit of a base for now? And the dollar's also moved below that 109 mark. What do you think about that?
So that is completely related to the inflation data, the CPI particularly, but also the PPI, which were both, but particularly CPI, were a little bit lighter than what people had feared, and certainly a little bit lower than consensus. Not hugely, but just enough to cause some of the fears that had grown that inflation is about to flare up in a meaningful way, that the Fed will not be able to cut anymore. And now there's some hopes that the Fed may be able to cut in the next 2 to 3 months. So I think that, look, one data point doesn't make for a complete victory celebration, but it still clearly has taken the pressure off bond yields and therefore put a little bit of a breather on the dollar rally. So I think that's related to the inflation data particularly.
Follow up to that then, Arvind, is that positive for equities and for emerging markets? Finally, do you see a break in the selling that you've seen in so many markets in India as well? Foreign institutions have been unrelenting.
Yes, I think the risk-off was being driven by many factors, not the least of which was a dollar rally and concern about tighter, interest rate policy, or maybe no more easing from Fed. And so to the extent that the dollar has eased and hopes of Fed having room to cut more have grown, then that puts more of a risk-on move. And so, yes, in that sense, we've seen a bit of an emerging market relief rally that certainly, as long as the data stays benign, it could have legs. But remember, there's another thing to watch out for. What is Trump going to do on the tariff front? And that's that we'll get a better sense of in the next few days and weeks. There's going to be volatility. The one thing that we can be sure of with President Trump is maybe a little bit too much excitement in terms of news flow.
So just in relative terms, Arvind, President Trump coming in, dollar has already run up in anticipation. Does that continue? And if you have yields maybe coming off a bit, then it's not looking that great in terms of fund flows for emerging markets and India as well, right? How do you rate or how do you assess the fund flow direction as far as India is concerned? Because it's been unidirectional one way, and money going out in hefty sums.
Well, so let's get away from the interest rate and talk about earnings and outlook fundamentals. Yeah. There's a lot of optimism in the U.S. about the U.S. economy, with Trump clearly favoring much lighter regulation, taking some meaningful action there, and being more clear-cut on keeping taxes low and maybe even lowering them a little bit. So I think that those are two positive factors which are keeping investors interested in keeping money to work in the equity markets in the U.S. And then you have the third leg of the stool, which is the whole, AI boom and everything related to that, that Trump is going to be positively disposed towards accelerating to the extent that he can, although that's really driven by, the private sector. Now, if you want to contrast that to emerging markets, the China GDP numbers that came out, I think there's a lot of skepticism about GDP number prints. The economic data in general from China has been quite weak. Other than exports, almost nothing else looks particularly strong, although I think it's kind of bottomed. India has maybe not as big a problem as China, but still, I mean, it was 5.4% GDP growth in the September quarter. I don't know what we're going to come out with in the December quarter. Will it be 6? Will it be 6.25? Will it be 6.5? But it's clearly in a slowdown. So I think at the end of the day, investors invest for earnings growth, valuations, earnings upside. And right now, I think many parts of the world there are some value markets, but growth is the missing ingredient that will cause big risk on whether it's in India or in other parts of the world.
Okay, whether it's in India or other parts of the world. But I want to come back to you with a follow-up on the China point, because we were discussing it just before you joined in, Arvind, and the figure, it's a robust figure, 5.4% for this quarter. Does it ease some concerns on the China growth trajectory and the credibility of that number? I'm just wondering, and putting it out there, correct me if I'm wrong, any data of this kind will be seen with a pinch of salt till there is more supporting evidence? Would that be fair to say?
Absolutely. I don't think this is going to cause investors to jump up and down and say everything is, getting better. I think the other data has been so much less visibly strong that it's hard to get too excited about China GDP numbers. As you can see from the, tepid reaction from the Chinese investors in the Shanghai market, I don't think anybody's taking this to the bank and saying, wow, we're off to a much better outlook than expected. So I don't get too excited about this number.
Okay, thank you so much for that, Arvind. Always pleasure to chat with you, Arvind Sanger there. I mean, Chinese data looks good on the face of it, but I suspect that anyone analyzing data coming out of China will wait for supporting high-frequency indicators to bump up that story or support that story that really there is any kind of a recovery in the Chinese economy.